First up, the balance sheet. This statement gives you a snapshot of a company's financial position at a specific point in time. Think of it like a financial selfie. It shows you what the company owns, assets, what it owes, liabilities, and what's left over for the owners, equity. Assets are things the company owns that have value. This can include cash, inventory, equipment, and even things like trademarks and patents. Liabilities are the company's debts. These can be short-term obligations like accounts payable or long-term debts like loans. Equity represents the owner's stake in the company. It's what's left over after you subtract liabilities from assets. The balance sheet equation is simple. Assets equal liabilities plus equity. This equation always holds true. Understanding this relationship is crucial for analyzing a company's financial position. The balance sheet helps you assess a company's liquidity, its ability to meet short-term obligations, its solvency, its ability to meet long-term obligations, and its overall financial health. Next up, we've got the income statement. This bad boy tracks a company's financial performance over a period of time, like a quarter or a year. It tells you how much money the company brought in, revenue, how much it spent, expenses, and what was left over, net income. Revenue is the money a company earns from its core business operations. Think sales of products or services. Expenses are the costs incurred to generate that revenue. This includes things like the cost of goods sold, salaries, rent, and utilities. Net income, also known as profit, is the bottom line. It's what's left after you subtract expenses from revenue. The income statement tells you if a company is profitable, but it's not just about the bottom line. Analyzing the different expense categories can reveal a lot about a company's efficiency and cost structure. By comparing income statements over time, you can track trends in revenue growth, cost control, and overall profitability. Last but not least, we have the cash flow statement. This statement tracks the movement of cash both in and out of a company over a period of time. It's all about the Benjamins, baby. The cash flow statement breaks down cash flow into three main categories: operating activities, investing activities, and financing activities. Operating activities relate to the company's core business operations. Investing activities involve the purchase and sale of long-term assets like property, plant, and equipment. Financing activities involve transactions with creditors and investors, such as issuing debt or equity. The cash flow statement is crucial because it shows you how a company generates and uses its cash. A company can be profitable on paper according to the income statement but still face cash flow problems. The cash flow statement helps you assess a company's ability to generate cash from its operations, its investment decisions, and its financing strategies.